Thank you, Mr. President. I'm here to discuss the merits of Senate Bill 2155, a bill that I've been working on since coming to the Senate in 2013, a bill that addresses the concerns of rural financial institutions, particularly those in our rural communities, a bill that was drafted to address access to capital concerns and consolidation of small banks in areas where I live, which is in the state of North Dakota. It's a bill that I am incredibly proud of. I know there's been a lot of statements made about this bill in the last week, and I'm here to set a lot of those straight. But before I start, I want to talk about what it is like in rural communities where I grew up. I find it interesting when I hear that this bill is about Wall Street banks and big bank bailouts. Last time I checked, Lincoln State Bank, which is my small community bank in the community that I went to high school in Hankinson, North Dakota, is not on the Fortune 500. It's not on the Fortune 100. It is a small community bank that has been operating and has been available to consumers in my community to help them achieve their family goals, achieve their farming goals, and achieve their needs going forward for capital. I don't recognize the bill that's being debated here in the United States Senate because it's not the bill that's been written, and it's not the bill that has, in fact, is hopefully going to pass the United States Senate. And so I don't think that it's any mistake when you look at the five primary sponsors of this bill, the five of us who wrote this bill, that most of us are from predominantly rural states. I think we understand the needs of those living in our states and the needs of those living in our rural communities. When you look at an opportunity to fix regulation and to respond to concerns that people have, one of the constant arguments that I get when I come home is there's no longer any common sense in Washington, D.C. They don't understand where we live. They don't understand who we are. They don't understand that we live in communities and that we support and protect each other. Instead, they write one regulation that's supposed to be one size fits all. Well, that's certainly not what this is. This is an attempt to write a bill that would give direction to the federal regulators so that small banks could be treated as small banks and large banks could continue to be regulated and treated as the large systemically significant institutions that they are. I'll give you just a few statistics that I think everybody should understand. 30 years ago, there were approximately 14,000 banks in the United States. Today, there's approximately 5,000. Since the passage of Dodd-Frank, the United States has lost about 14% of its smallest banks. Meanwhile, small banks' share of U.S. domestic deposits and banking assets have decreased, and the five largest U.S. banks, which don't benefit from our bill, appear to have absorbed much of this market share. What I have said consistently is Dodd-Frank was supposed to stop too big to fail, and the net result has been too small to succeed. The big banks have gotten bigger since the passage of Dodd-Frank, and the small banks have disappeared. And they have retreated from their traditional role of relationship lending, first out of fear for regulation and that they might be doing something wrong, and then out of fear for the cost of regulation if they're going to work towards compliance. So I want to just make one simple point. This bill was not written by Wall Street bankers. It was not written by Wall Street lobbyists. If it were, it would be a completely different bill. This bill would actually provide relief to Wall Street banks and Wall Street bankers, and it does exactly the opposite. It gives relief to those institutions, whether they're regional banks or small community banks, that can be effective competition for the largest institutions in this country. And so it is absolutely essential that we set the record straight that this bill is to get our relationship institutions, whether they're credit unions or banks or our regional institutions that are not doing anything more sophisticated than the work that's being done in our small community banks, to get them the regulatory relief that they need to effectively compete against the biggest banks in this country, and to tailor our regulations, to set our regulations in a way that reflects the common sense of the American citizens. So I want to just take a minute, because I think a lot of things that have been said about this bill have been incredibly reckless. And these inaccurate claims, if left unchallenged and undiscussed, will create the legislative history of this bill, which could in fact then be used by many of the same institutions that we believe are not affected by this bill to argue that they were entitled to some sort of protection. We can't let that happen. So let's start out first by saying this is not a giveaway to Wall Street. It is not a giveaway to the largest institutions. Our bipartisan bill makes targeted, common sense fixes so it will provide tangible relief to community banks and credit unions so that they can lend to borrowers in rural America and support rural communities. It leaves in place rules and regulations that hold Wall Street accountable. In fact, the big banks aren't necessarily happy with this bill because it doesn't benefit them much. And when we ask the current regulators, such as Fed Reserve Chairman Jerome Powell, he basically has said that he believes that the bill gives the regulators the tools they need to continue to protect and prevent against financial collapse. Let me say how the bill doesn't help the largest institutions. It does not make any significant changes to the regulations facing the largest Wall Street banks so that they continue to be reined in from causing havoc to the financial system like they did during the financial crisis. It does not make any structural changes to the Consumer Financial Protection Bureau. It is allowed to continue to protect consumers. It does nothing to weaken or repeal the Volcker Rule. The only institutions which will be given any relief from the Volcker Rule are those banks which are under $10 billion in assets. That is not JP Morgan, that's not Citibank, that's not Goldman Sachs, that's not the largest institutions. $10 billion or less, the only institutions that get relief from the Volcker Rule. And it does not change the way the Federal Reserve regulates foreign banks. Second, this bill will not lead to another mortgage lending crisis. Let's just go back and examine what happened in 2008. We had a significant number of liar loans, subprime lending, which drove the mortgage market. That was troublesome and problematic in and of itself. But the real problem came when those mortgages were securitized and sold into the secondary market. That's where the trouble began. It was trouble enough that they were putting institutions at jeopardy, but they were passing along that risk to the public through these securitized products, derivatives. Guess what? When the whole thing collapsed, we looked behind and we saw these risky mortgage loans. We saw what actually created some of the problems on the front end before it was securitized. Nothing in this bill changes qualified mortgage standards. Nothing in this bill removes the protections that Dodd-Frank has provided to the secondary market. The only thing this bill does as it relates to mortgages is it says those small institutions, the small community banks that I'm familiar with, they can make mortgages without worrying about the qualified mortgage standards. They can go ahead and do that. But the one thing they can't do is they can't sell those mortgages into the secondary market. They have to keep those mortgages on the books. And when you have a requirement that they keep them on the books, do you really honestly believe that these institutions are going to take unnecessary risk? The answer is no. Guess what? They didn't take unnecessary risk before 2008. They did not cause this problem, but yet they are incurring the bulk of the expenses to fix this problem. So to suggest that we are, in fact, risking the financial security of this country, of our institutions, because we gave a small, discrete break on mortgages to the smallest of institutions who have to keep these mortgages in portfolio is absurd. It's not only absurd. If you don't want to believe me, let's look at what Congressman Barney Frank, one of the architects in Dodd-Frank, said yesterday. He said, "Nothing in this bill in any way weakens the prohibition about making shaky loans, loans to people with weak credit, and packaging them into securities. Our bill restores the balance for small community banks in the mortgage business without opening up the door to excesses that led to the predatory lending standards which led to the financial crisis." To suggest otherwise is disingenuous and simply not true. And so we have to push back against this idea that somehow we are rolling back the clock. In fact, in this same interview, Congressman Barney Frank said about 95% of Dodd-Frank as it is written will remain intact after this bill passes. 95%. You would not believe that to listen to the dialogue and the diatribe that we've heard on the floor. So the third misstatement is that we will somehow scrap the rules for the largest Wall Street banks and allow regional banks with up to $250 billion in assets to follow the same rules and regulations as the tiny community banks. Again, not true. Far from scrapping the rules, our bill simply provides that the Federal Reserve has the ability to tailor just one piece of Dodd-Frank, and that is Section 165 regulations. And for certain regional lenders, that means that if they do not pose systemic risk, they will not be subject to the requirements of 165. But if the Fed determines that they could, as in the case, as you've heard, of Countrywide, if there is another Countrywide out there, and the Fed discovers another Countrywide, they can, in fact, include that institution in 165. And so let's not exaggerate the impact of this bill. Let's talk about how we simply have moved the assumption from 50 or 100 to 250 in terms of what is systemically risky, knowing that the Fed can always go back and include a smaller institution if they in fact see the challenges. I think the other thing that we need to point out about the Dodd-Frank regulations and consistent regulations moving forward is that our bill still requires very rigorous stress testing for these regional institutions. The regional institutions would have to have the ability to meet those stress tests. And Chairman Powell, at his confirmation hearing, called the framework of this bill a sensible one. And he affirmed that he would like to continue meaningful and frequent stress tests on banks between $100 billion and $250 billion, as provided in this bill, while confirming that it isn't necessary to stress test the smaller banks. I think that this position is supported, again, by Janet Yellen, who said, "I do think it is appropriate to tailor regulations to the system footprint of financial organizations," and called our bipartisan Senate bill a move in that direction that I think would be good. Moreover, our bill does not change risk-based capital and leverage regime for these regional institutions under Basel III reforms. Relatedly, our bill does not change the fact that comprehensive capital analysis and review, or what we call CCAR, applies to these regional banks. And of course, the Fed has said it will continue to implement enhanced prudential standards. So in addition to stress tests that are required under this bill, for some banks over $100 billion, we have all of these other requirements and the requirement that they continue to meet qualified mortgage standards. They can sell these mortgages into the secondary market if they meet those standards. And so it's critically important that we be very, very clear about what this bill does and does not do for our mid-sized or regional institutions. Fourth, and probably the most hurtful of claims that have been made, is that those of us who care deeply about preventing and eliminating discrimination in lending somehow have opened the door to allow for discrimination in lending by changing the HMDA standards. That is an outrageous claim, and particularly hurtful for the members of this body who have spent their life fighting discrimination. I want to talk about the facts. Our bill continues to require that all lenders, irrespective of size, collect the traditional HMDA data, which includes information on race, gender, and ethnicity. Contrary to what some have said, our bill only relaxes the new additional data requirements for some of the smallest lenders in the country. By that, those who make less than 500 loans a year. This data only makes up 3.5% of all the data collected under HMDA. Think about that. We are claiming that people are discriminating and allowing discrimination because we are relaxing the standards for the smallest institutions, and it only amounts to 3.5% of the total data collected. 3.5%. This is an outrageous statement, and it needs to be corrected on the record. So you might say, why even change the 3.5? Because for those small institutions, the 44 pages of data that they're required to collect may in fact mean that they no longer are interested in doing those kinds of mortgages. And so it is really very, very important that we correct the record. And in fact, I asked Chairman Powell during a recent banking committee to clarify whether he believed the change in 2155 would result in or lead to additional discrimination in lending. He said he did not believe that it in any way would affect their ability to enforce the fair lending laws in this country. Fifth, some have inaccurately alleged that the change from may to shall in the tailoring is a dangerous provision that empowers big banks to secure more favorable treatment from the government. I think that that claim does not stand up to scrutiny. First, it's just common sense that we should tailor federal regulations so that they're implemented in a practical and effective way. Second, in our bill, we retain the broad rule of construction under Section 165, which provides the Federal Reserve with wide latitude to tailor prudential standards to any company or category of companies based on any risk the Fed deems appropriate. Pretty broad authority on the part of the federal government. Third, in the event of a lawsuit, the Fed would be given strong deference by the courts to interpret what might apply to 165. Sixth, our bill would not open up targeted reforms to the supplementary leverage ratio beyond 3 custody banks. Under the plain reading of this bill, the 3 custody banks are the only 3 institutions that are predominantly engaged in custody business. Of course, the regulators retain the discretion to make appropriate adjustments to SLR. And to be clear, there is broad agreement among the regulators that the unique business model of custody banks warrants tailored treatment under the SLR provisions. This is why a substantially similar bill passed the House Financial Services Committee. No lighthearted people there on the minority side, by a vote of 60-0, and passed on a voice vote in the House. Finally, our bill will not gut oversight of foreign merchant megabanks operating in the United States, such as Barclays and Deutsche Bank. These 3 institutions, all of which have over $150 billion in assets, will be subject to 165 of Dodd-Frank. That means that foreign banks will still be subject to foreign bank stress test requirements, liquidity stress testing, and strict Basel III capital requirements. And our bill does not change the Fed's requirement that large foreign banks establish an intermediate holding company in the United States, which subjects a foreign bank's U.S. operations to requirements similar to those imposed on U.S. banks. Now, Chairman Powell, again, in the March Senate Banking Committee hearing, was asked about this, and he said he did not believe that this bill would exempt foreign banks from tough oversight under Dodd-Frank. Additionally, the substitute amendment for this bill has affirmed that large foreign banks do not escape Dodd-Frank supervision. I think it's really important that we debate the actual merits of this bill and not the boogeyman merits, the statements that this bill will somehow lead to catastrophic downfall of our financial system. As I said, even Barney Frank disagrees with that evaluation of this bill. It's important that we set the record straight on what this bill does and does not do, and that we make sure that when a court is reviewing this provision, if in fact there is ever litigation, that the court has a record to go to on the floor of the Senate and in the committee which corrects misstatements and refocuses this bill on what the actual intended outcome is and how the bill was actually written. And so with that, Mr. President, I'll yield the floor, but I'll say that I intend to submit a document for the record in the next discussion, which hopefully will provide a written document outlining the myths versus the facts of this bill so that we can have an actual record that the courts can look to that documents the intent and the purpose of this legislation beyond the hyperbole and overstatement that you've heard. So thank you, Mr. Chairman. Mr. President, I yield the floor.